Guidance for Returns by Emily E. Brantneri for Jacqueline Felder Strauss. Intermediate Accounting, AC 300, May 27, 2023. Purdue Global. New Shoe Zoo warehouse needs guidance on returns coming back to the warehouse from their first ever client merchandiser. The Sole Proprietor. Per the Accounting Standards Codification, ASC, and the Financial Accounting Standards Board, FASB, New Shoe Zoo warehouse should begin by coming up with a conservative estimate amount of merchandise that they expect for the sole proprietor to possibly return for a refund or a client credit. Let's say New Shoe Zoo warehouse sells 24 pairs of designer pumps to the sole proprietor at a cost of $120 each on September 2nd. The sole proprietor is expected to remit payment to New Shoe Zoo warehouse within 90 days of this date, since this is the date their shoe shipment arrived. New Shoe Zoo warehouse has explained in their agreement that they will allow for returns from the sole proprietor so long as they find that New Shoe Zoo warehouse had made an error in picking the order or there is a manufacturer's defect found. Cost of each pair of shoes is $80 at cost for New Shoe Zoo warehouse, and they expect the sole proprietor will return about 8% as they work out the kinks in their freight packing department. Since New Shoe Zoo warehouse expects 8% of the shipment to be returned, Mataya the Mathematician Monkey of New Shoe Zoo warehouse will debit their accounts receivable for the full amount of the sale, in which this case would be $2,880. Then Mataya will take the New Shoe Zoo warehouse's conservative return estimate of 8% of the $2,880, which will be entered as a credit in a refund liability account, since they now have a legal obligation to generate this money for a return to the sole proprietor if necessary, being the refund liability is $230.40, the remaining 92% or $2,649.60 is the sales revenue they are permitted to recognize from this transaction. Mataya says that per the FASB Codification that the New Shoe Zoo warehouse must bear in mind that their firm cannot recognize 100% of their cost of goods sold in this transaction with the sole proprietor, since they are still holding out in an expectation of 8% return of merchandise. Since the designer pumps cost $80 a pair for New Shoe Zoo, and they have moved 24 pairs, Mataya will credit their inventory account for $1,920. Of this $1,920, they are only permitted to recognize 92% of inventory for their cost of goods sold, which is the corresponding percentage of recognizable sales revenue at this point in time. This makes for a debit in COGS equal to $1,766.40. The remaining 8% of the inventory account will be $153.60 debited from an asset account titled Right to Return. Now, the New Shoe Zoo warehouse plays the waiting game. When October creeps up, the sole proprietor realizes that the New Shoe Zoo warehouse has sent them one pair of pumps in which both shoes only fit left feet. They are exercising their legal right to return the pair of left foot fitting designer pumps per the terms of the mutual sales agreement. Let's see how Mataya journalizes this transaction per the FASB Codification. Mataya says since one pair of shoes is coming back, New Shoe Zoo warehouse will debit the refund liability account for the price that the sole proprietor paid for the designer pumps of $120 and then credit accounts receivable $120 to make good on the refund amount. Since the shoes only cost them $80 at cost, only $80 is debited from their inventory and then placed into that right of return asset account. The money or client credit is now back into the possession of the sole proprietor. When the 90-day return window closes for their mutual agreement on November 2nd, New Shoe Warehouse will recognize the remaining refund liability from September 2nd as a debit from the $230.40 less the return made in October of $120. This creates a debit and refund liability of $110.40 to be credited to the sales revenue. Mataya has also journalized that New Shoe Warehouse has sold all the merchandise remaining to the sole proprietor. At the end of the return period, the right of return asset is then credited against the remaining $73.60 in cost of goods sold. Mataya found this by taking the right of return asset account figure from September of $153.60, less their inventory cost of $80. Now, all that is left for the sole proprietor to pay is their balance subtracting the $120 return from their invoice. Mataya executed that journalizing flawlessly. Some businesses will face more challenges when it comes to returns, and it's not because they closed on employing Mataya the Mathematician Monkey. That monkey deserves a salary increase, but I digress. As I was saying, places such as Meds for You, who wholesale prescription drugs to skip the pharmacist, may see more challenges in recognizing revenue when offering the right to return for their clients. Skip deals with a multitude of return policies while ordering his inventory from suppliers. However, he has found that Meds for You offers an extended return policy on their prescription drugs. This extended right to return period is offered to Skip and Skip's customers since he is selling perishable prescription drugs. Other reasons behind Med for You's prolonged return period could be from changes in demand for certain prescription drugs or newly introduced medications, or quite possibly publicized side effects. In this market, Meds for You and Skip deal in a large volume of returns, and it may be difficult for these companies to pinpoint a conservative estimate of product that will be returned. But the FASB and codification standards say that they should sufficiently try. However, transactions involving channel stuffing by prescription drug manufacturers and other excessive increases in inventory can contribute to the difficulty of reasonably estimating returns in this market. Key sources.